Hey everybody, welcome in to Mining Stock Daily. It's a shorter week here because of personal commitments and travel schedule on my side. Taking a vacation, short hiatus, but we should be back early next week with the regular scheduled programming, typical here on Mining Stock Daily. So we're going to leave you with this longer conversation. You can consider it this week's long form episode. We welcome in a new guest, somebody who's been involved in the junior mining market for almost 20 years now. Former newsletter writer from Stansbury, now just kind of connoisseur of all things junior mining, and he is candid with some of his opinions. Yes, we welcome in Mr. Matt Badiali into the podcast for the first time. Wide-ranging conversation on many different topics, including the status of junior mining and these markets right now. But where there is crisis, there is opportunity. Let's keep that in mind so we can talk about this and a number of other things with Matt. Special thank you to Western Copper and Gold, Arizona Sonoran Copper, and also Fireweed Metals for their continued support of the podcast. And if you wouldn't mind, please leave a review of the podcast on the network you use to listen to it. Just does us a great amount of good to get this podcast into front of new investors interested in commodities and the metals exploration space. All right, let's jump into my conversation with Matt. Have yourself a wonderful rest of your week and weekend. Talk to you soon. Be well. Hello, everybody. Welcome back to Mining Stock Daily. Trevor Hall here. This will most likely be this week's last episode, as I'm taking a vacation. I'm going to take a road trip and see some music. And so step away from the computer, the podcast, and step away from the markets because these markets are brutal. So we're going to have a general conversation here with a new guest, somebody I followed online. In fact, I find his content that he puts out on Twitter very candid and I think it comes with a lot of value. Happy to welcome in Mr. Matt Badiali. Matt, welcome to the podcast. Welcome to Mining Stock Daily.
Thanks very much, Trevor.
Yeah. It's good to have you on. Since we have you on, what is the ethos? What is your ethos? Where do you come from? What do you do? And what got you involved in this crazy sector?
It is a crazy sector. I'll tell you what, in 2004, I was grinding my way through a PhD program. I was in my 5th year. I went in with a master's degree. Everything that could go wrong in that PhD went wrong. And then my wife became pregnant. And so it was time to ditch academics. And at the time I was, I'd been friends socially with a guy named Dr. Steve Sugarud, who was one of the co-founders of Stansbury Research, which is an Agora newsletter. And they needed somebody to come do oil and gas analysis. They needed a geo, and they needed somebody who could write and present. And I guess I like to say I fit the bill, but the truth is I'm probably the only geologist Sugarud knew. So that's how I came on board with those guys, and Steve and Porter were kind of the principal guiding lights in teaching me finance. Kind of, I could do numbers because I'm a scientist, but the financial side was different. And I've had a number of really influential mentors over the years. Steve, Porter, Rick Rule has been a big help. A guy named Dan Ferris is a good friend, has been a big help as well. And I'm a voracious reader. So I follow and read lots of different people. So that's really where I come from. Good, bad, or indifferent. The newsletter space is where I grew up in the, learning finance.
Yeah. So I guess academically, you studied geology?
Yeah. I'm a sedimentary geologist. I got an undergrad from Penn State, a master's from Florida Atlantic, and then I went to the University of North Carolina at Chapel Hill with the intention of either going to work at ExxonMobil or becoming a professor. And what I learned in those 5 years at Chapel Hill was that I was not cut out to be a professor, and my wife would kill me or leave me if we moved to Houston. So those didn't work. But my kind of my first love was always sedimentary geology, and I ended up spending a lot of time in West Texas, in Midland and Abilene. Developed a big network of folks there, which really helped me in my financial life as well.
So more oil and gas, it sounds like, academically.
Yeah, but the thing is, exploration is exploration,
Hmm.
and so the transition to mining exploration was. Um, it was something I could get my head around pretty easily. They're both capital intensive. They're both businesses where, in oil and gas, the main difference between oil and gas and mining is when you drill an oil well, it's a binary question. It's a yes or no. You have oil or you don't, right?
Yeah.
Mining exploration, depending on what the end goal of the company that you're talking to is, if they're a lifestyle company, they drill a hole and they're like, "Whoa, we're going to raise some money and we're going to go back and see what we, so sometimes it's a real yes, it's a reason we have to follow up on this, but sometimes it's in the oil and gas world, we would move on to the next prospect.
Yeah. Drill and kill type of thing.
Drill and kill, exactly.
So, okay, so I wasn't expected to throw this question out here so fast, but with this experience that you've had in both
Yeah.
oil and gas and in mining, where did the miners go wrong? How do you take this back? Or is it more of like a
Mining's hard.
generational thing? You
No,
know?
yeah, mining exploration is hard.
Right.
Um, and it hasn't been supported very well uh, from a financial and capital infusion. Uh, when I look at it in the context of oil and gas, you know, up until probably 2016, you could get credit as an oil and gas guy. Anybody, you and I could go out and form an oil and gas company. We could have gone out and gotten a pretty big credit revolver, and with the idea that we had pretty good geology, we drill some successful wells, and then the reserves, the oil that's in the ground, we can use as collateral to then borrow even more money. And
Mm-hmm.
mining, the problem with both of these, mining in particular, because it's mining is like really slow and really long lived, and they're price takers, right? They're price takers. The stuff they're selling, somebody else is setting the price, and the stuff that it costs to put in the ground, somebody else is setting the price, and so you just never know. And that lack of certainty means that bankers don't want anything to do with you.
Right.
So my overall take is that mining is just always undercapitalized, underfunded. Exploration's always underfunded. But the other side of it is, um, mining has had a legacy of crooks. And you go
Yeah.
back to Briex, and they're making movies about shysters. I mean, Mark Twain said, the definition of a gold mine is a hole in the ground with a liar in the top.
Mhm.
So that also adds a layer of uncertainty to it.
Well, but it seems like it's always been that way. I've read books and heard stories about the old timers, in Nevada around the old Comstock. And it was the exact same way in the 1800s as it
Mm-hmm.
is now, that, you could buy shares of a mine at a certain price with no guarantee whatsoever because they don't quite know what's behind that face, right?
Yeah.
But it does seem like it's those stories of fortune. It is that continued gold rush that keeps people coming back to it. But we're in this situation right now where degenerates such as myself, and I don't know you well enough to put you in that label, but we can't, even if these such poor markets, we still have, we still got diamonds in our eyes. And
Yeah.
what is it? I mean, is it just that, that chance to make forever life-changing wealth that keeps people like myself digging into these juniors?
I mean, it's the most satisfying adult Easter egg hunt ever. You know, I
Right.
haven't gotten rich yet, but I still feel great when I'm right. When I'm like, oh man, I knew that one, right? And the kind of the fun thing about the newsletter business is that I got to deal with and meet lots and lots and lots of just regular Joes who loved mining investing for the same reasons I did, which was this the ability to turn a scientific concept into wealth is just so overpoweringly cool to me. And it's not just mining, and it's not just oil and gas. It's creating a new drug, right, or developing a new a new IT project, a new app. You take your intellect and you create something that everybody wants. That's how you create wealth. I find that to be endlessly satisfying. But it doesn't always turn out that you're a millionaire overnight.
Mm-hmm. Mm-hmm.
But it does. I bought my wife a car one time on a pretty good. I can't call it an investment. It was a speculation. That's fun.
Yeah. So tell me about this transition from going from, from academia into the research and the finance side of things.
Mm-hmm.
I've granted I've had to learn from drinking through the fire hose on both of those myself, as somebody who doesn't have an academic background in geology nor in finance. So I've had to really learn as I go here. But that transition is not easy, is it?
It is not, and you've paid tuition just like I did, whether you're paying a university or
Right.
you're paying somebody
Yeah.
who's selling you shares. You've
Right.
paid your tuition. There are a lot of parallels, and there are a lot of just really massive differences. I think the best skill that I learned is critical thinking. Coming from academics, I had a grant when I was at UNC, and it was very small, and so I had to really pare back all the things I wanted to do and focus on the thing that would get me the next grant or to get a chapter written or whatever it was.
Mm-hmm.
And when you look at when you look at projects, you really have to do the same thing. You have to cut immediately to what is the part of this project that will drive this stock to the next price or allow these guys to raise money at a higher price. The hardest thing for me to get my head around in the beginning was that all of these projects have to eventually become businesses. Ultimately, that moose pasture thing has to be as profitable as the Starbucks on the corner, or else your investment's wasted. So somewhere in there, and finding that piece, and it really does come down to math. There's I've had, like, I think Brent Cook does a really great job with, he looks at even exploration projects and with the ultimate lens of, is this going to be a business or is this going to be a science project?
Mm-hmm.
And I have a lot of time for that. I admire those folks. I'm not great at it, but what I've done is try to find people that do a better job than I do at it,
Yeah.
and then ask them, "Hey, did you see that project? What do you think of that one?"
Yeah.
So,
But it, so what was something maybe you took away, as far as, you walked away bruised, but
I
mostly unscathed. Like those early lessons from reading markets and finance.
oh man, uh, you know, I learned a lot of, I hadn't been doing it very long when 2008 hit,
Mm.
and so um, I think at the time I had probably 60 or 70,000 readers who were retail investors, and we weren't really. I wasn't doing a whole lot of junior mining, a little bit, but one of the things that I had to do was figure out um, how to sell, because it's an emotional. You have to overcome that emotion. That was the really hard part. This idea that, man, I can't believe this stock is going down. I believe in the stock. I believe in the people. Why is the stock going down?
Mm.
You can't fall in love with these things. You've got to be able to cut your losses. And so I was introduced to the concept of trailing stops, which made sense to me because one of the things I think most, and I made this mistake as well. I made every mistake in the book as an investor. The first thing that Steve Sugarwood made me do was open a trading account, because as a grad student I didn't have one. So I put $10,000 into a trading account, and then proceeded to lose half of it. And by making every mistake in the book, was discovering how to sell that changed that. The ability to divorce yourself from your emotions and say, yes, I like that company. Yes, I'll come back to that company. But right now there's some event in the market that I don't understand. That means I've got to sell this position. And I would put 25% stops on my positions. And if it fell 25%, I'd sell, and we'd wait to see what happened.
Mm-hmm.
2008 comes. I've got 60,000 readers. We sell every single position in our portfolio.
Wow.
And at the time, I didn't, you're a newsletter writer. I've got nothing in my portfolio. And we didn't recommend anything for 2 months because I just really didn't know what to do. Everything, things were falling. You'd say, well, what about this one? And a week later, it would be down 25%. So we ended up actually recommending puts. And I don't think many of my readers were savvy enough to do it, but that was the only thing that we could do that worked. But really, that time period, that made, I had to stop making mistakes pretty quickly and learn how to sell and how to not buy and how to sit on my hands, which is another thing I didn't do very well in the beginning. I would read something and immediately run out and buy it,
Mm-hmm.
and then lose my butt.
Well, that's obviously a tough place to be. It's the idea of writing a newsletter, especially in junior mining. The back of my mind, I mean, it's daunting enough for me to publish a podcast where we do not give recommendations. I mean, I try to be transparent to as much as I can to say, who's who's sponsoring the podcast, what companies I'm invested in. But
Mm-hmm.
by no means do I want listeners to think like that's a newsletter style, like you should buy this company, this is what we're doing.
Mm-hmm.
But I do, harking back to the fall of March 2020, in a number of newsletters that I read or I kind of hear wind of from the other readers, there were a lot of junior mining newsletter writers that sold everything. And I think in the back of my mind, I actually kind of thought of it as a contrarian thing,
Mm-hmm.
because I thought it's like, well, we're already down huge. You should have sold days ago. And then we saw this massive V-shaped recovery and everything came back so quickly. So then you're forced chasing.
Yeah.
And so, so I don't envy that. I don't envy that, that position those newsletter writers are in. They do, a lot of them do a really great job, but when you're in that type of volatility, I mean, that's where you really gotta, I mean, you got to stick with your guts, don't you?
Well, yeah, that juniors are harder, and they're harder. We used a 50% trailing stop because basically,
Mm.
the worst thing you can do as a newsletter is to blow up your readers. A newsletter is its goal is to serve its readership. At least that was what we were doing. The Agora, Stansberry Research. We weren't allowed to personally own any of the stocks we wrote about.
Mm.
And we had to be very diligent about not taking people to zero on a position or taking people down 90% on a position. Because a lot of these folks, this was speculative money, but it wasn't speculative enough. You could lose 90% of it. So I tried to be very aware of um, what was going on in the junior space, and particularly in the companies I was in, it still was it's a minefield.
Mm-hmm.
It's always the stuff you don't know that gets you, which is why one of the reasons why I advocated trailing stops. And I promise you, when you publish this, you're going to get, there'll be 15 comments and they'll all say, Matt's an idiot. You never sell your stock. If the stock's going down and you liked it at this price and it fell 25%, you buy more. But here's the thing that I know is you run out of money.
Mm-hmm. Mm-hmm.
Averaging down is great until you're not liquid anymore. And man, we're very close to that right now. I spent a week in Vancouver talking to brokers, and there's a lot of pain and suffering going on up there right now.
There is. I've heard of some major gold and mining funds getting redemptions, and so they're forced to sell.
Yeah.
This is just kind of word on the street things that I'm hearing, but it's really dire out there. I guess the question I guess everybody's asking is like, well, we all know it sucks, but how long is it going to suck? You know, I mean, there's got to, it's usually the worst right before the dawn. I mean, I don't know if we're even close to seeing the dawn yet here, Matt.
Yeah, I'm terrible at forecasting. That's just not my thing. The math, at least in the base metal space, the math looks like we should be turning the corner. I mean, certainly for copper, that's which is one I've been pounding the table on. The the demand and supply numbers don't add up, and
Mm-hmm.
they really don't add up quickly. So it's not like when you look at the numbers, you're like, oh, in 10 years we're gonna run out of copper. It's not like that. It's like 18 months, and you're gonna see the divergence in supply and demand that should lead to higher prices. I mean, the Daniel Yergin is a guy that I love to read. He wrote a Pulitzer Prize winning book called The Prize, and it was the history of oil.
Mm-hmm.
Brilliant. I mean, because it was something I was really interested in. And this isn't the geology, although there is some of that, but this is the macroeconomics of oil. I mean, the oil is what made the world go round. If you wanted to field an army, you needed petroleum. If you wanted a navy, an air force, if you wanted to go to the moon, petroleum was the stuff you had to have. And so its impact on global economics was massive, and it still is today. And Daniel Yergin came out in a report a couple months ago and said copper's the new oil. He said that if when you look at the oil market, I think it was 40% of the oil market is tied up by 3 countries. And you look at the copper market as we stand here today, and 38% of all the copper being produced right now is tied up by 2 countries. So the forcing mechanisms are out there, but they're not happening in the short term, right? So we're not seeing copper's not kind of pricing that in and building out. When does it happen? I don't know. Does it happen really
Mm-hmm.
fast? I mean, it did like that end of 2008, beginning of 2009 to 2011. That was a rocket ship, you
Right.
know, that
There's a
we
lot
went
of there's
from,
a lot of stimulus back then, though.
yeah, it was we were coming out of a crisis, but I mean, we got to the point where people were stealing pipes and wires out of new houses for the
Mm-hmm.
copper in them, you know.
Yeah. Yeah.
But yeah, there was a lot of stimulus, and I think that we've had a series, certainly in Vancouver, we had a series of booms and busts that kind of pulled a lot of liquidity out of the market, and I also think it burnt a lot of fingers. So not as many people were writing checks. You had cannabis, you had the cryptocurrencies.
Matt, let's talk about copper more because you maybe have followed some of what I was saying on Twitter and whatnot and on the podcast. I've been a little bit bearish copper,
Yeah,
just really in the face of this recession that we're still
yeah,
waiting to come, and I think that really has priced copper lower. However, we got news that it seems like China is going to start stimulating again because that rebound off of their COVID lockdowns isn't as strong as one might expect. I mean, there you can.
Mhm.
I'm not a, obviously I'm not a mastermind on the Chinese economy, but I would have expected that boom to happen quicker, and it just hasn't. But there's news that more stimulus coming out of China. Um, in the face of a recession, obviously we know that there will be some sort of stimulus here in the United States and in most industrialized Western countries. And so I'm starting to kind of come back around to copper. Maybe it has seen its low. I'm not quite there yet, but it looks better. The price action looks better. I mean, you know, I, I think I'm starting to feel a little bit better. I mean, the sentiment around copper was just so bullish,
Yeah,
even when it
I
was
agree.
moving lower and lower. It was just so bullish, and I was like, this isn't this isn't right. So, do we ever get to a point to where people forget about copper? Because it doesn't seem like that's even possible.
No, it's so important. It's just it's the market is so big. It's in everything. I mean, I think people just forgot about it for a long time in the 90s and the early 2000s just because you know, it wasn't it was just copper. It was, priced as it was, and there were big companies producing it. Just kind of we didn't think about coal either.
Right.
And then all of a sudden we did because the prices ripped, the price of coal ripped, the price of copper ripped, and people started paying a lot more attention to it. There was money to be made. Um, but yeah, the interesting thing about the recession is we're all still waiting for the recession. Yeah, I think if you were doing a litmus test 3 months ago, we were all sure there was going to be a recession, and it didn't show up. Very interesting. The numbers kept. It was the jobs number that kept defying everybody. Remember,
Yeah.
like, how are we so fully employed? Doesn't the market know we're going to get a recession? Doesn't the economy know? Come on. And
Yeah.
then people just kept staying employed. At least here in the U.S.
Yeah.
But yeah, I'm not an economist, and so this is the sort of arm wavy stuff that I every time I start to talk about it, there's that voice in the back of my head that goes, "Man, stick to rocks."
Well, so what about the rocks? I mean, other than copper, I mean, what's on the top of your mind lately? In this bear market, you've got to find some sort of silver lining someplace, don't you?
Yeah, I mean, I'm still looking for grade. I'm still looking for, one of the themes that I've been writing about quite a bit is I think we're at a pivotal moment where, you're seeing a massive change in energy in the energy markets, and there have only been a handful of these things in history, right? There was the time where
Mm,
we went from wood to burning coal, right? That's a very important period in human history. And then when we pivoted from coal to petroleum, and so now, rather than a full switch, what I think we're seeing is uh, we're seeing a much more broad spectrum of energy sources coming on. So we're not solely reliant on petroleum or
mm-hmm.
coal or whale oil. Right now, we're able to bring on um, more sources more efficiently. And the really interesting thing about the technology that we're seeing, and so you have more efficient solar panels and wind turbines, but you also have modular hydrogen production, where you can actually use solar power and water to create hydrogen. And in here in the developed West, people poo-poo that. Come on, that'll never take. But if you're somewhere where your petroleum comes in by boat once a month, and you have the ability to make a fuel that can run vehicles
Mm-hmm.
at home with a solar panel and water, which you have, that's a game changer, right?
Right.
That's the economic equivalent of going from walking to having a horse. I remember years ago there was a gas field that was discovered. I think it was in the Bay of Bengal off India, and I was really interested in it. And I was talking to some of the folks in India about it, and I said, well, is it going to go to electric production? And they're like, oh no, it's going immediately into fertilizer, because they were importing. They were importing some really expensive hydrocarbon to make ammonia fertilizer, and this was going to cut the cost of fertilizer dramatically, which was going to allow them to make more money and grow more crops. And so it was a game changer for them. What we're seeing right now, with the ability to use lots of different sources to create energy, these batteries that keep getting technologically better every year, able to store energy, which really was the limiting factor, because solar panels only work half the time, and wind doesn't even, wind works when it works and it doesn't when it doesn't, but you have to be able to store that. And so that's what I see with the kind of the revolution that's going on in battery tech right now, and the advances in battery and the sizes of batteries, is this democratization of energy, this moving away from the reliance on just hydrocarbons, particularly in places that don't have their own source, or it's a limited supply.
Well, you put up an interesting point, because what I'm hearing from you is, I didn't hear we'd move completely away from hydrocarbons in what you just said. You said, just not solely based on hydrocarbons. And I tend to agree with you. And, I too did a little bit of a deep dive a few months ago when I was for my presentation at PDAC, and I was researching energy transitions throughout the history of the U.S., and I studied that transition from, wood to coal, whale oil, to using petroleum products for kerosene. I mean, it was very eye opening. But one of the big takeaways I remember, where I was like, it made perfect sense, is energy transitions. The medium term for that transition to go in full effect is 50 years. So you got a long timeline there, half a generation, let's say, give or take. And what happens within that 50 years is that the primary source of energy in the early stages of that transition becomes a huge supply for the transition to actually happen, or a huge primary force to make that transition happen. So if we think about it now, we're not going to decarbonize by kicking the can with petroleum. What is going to happen is we're going to need a hell of a lot more of it to make this transition actually feasible. And I keep on thinking about, why does it have to be one or the other? I understand. The people will say, well, the risk of climate change. I totally get it. But you can't have one without the other. We just aren't technologically there yet, and probably won't be in my lifetime. That's at least how I feel. So how do you approach this? Like, it doesn't have to be one or the other. We can have a little bit of this to get to the greater end game.
What happens with petroleum is it's so useful that it takes really high prices to get people engaged in trying to get away from it. And what we're seeing right now is that, the price is middling and coming down a little bit, enough so that OPEC's got to make a big, press release about, we're going to cut. Yeah, I don't believe it. But the other thing that happens is that natural gas is a byproduct of in the U.S., it's a byproduct of oil production. And we have a glut of gas. And so the gas prices are way down, and which makes it really, really useful. And so, if you have a choice between, buying electricity made from natural gas or buying more expensive electricity made from solar or wind, you're gonna buy the gas. You're gonna buy the electricity made by the cheaper gas, and so that actually is a headwind to this transition. So that's why it takes so long. Is that push and pull. Everybody, to switch metaphors a little bit, but when the Ford automobile was invented, everybody didn't run out and shoot their horses. Only the rich people had the cars, right? And then we very slowly over time, there was an efficiency there. There were economic benefits there. And ultimately, we went to vehicles. And the same thing with, kerosene. People didn't stop burning wood because kerosene came around. The people who could afford it used it. And then eventually it was just so useful. And it was economically viable that it spread all over the place. I think that one of the problems is, and don't tell anybody I said this, but I think we have short attention spans. Margaret wants this shit to happen now, and it's not how it works. 50 years? No, it's too long.
No, it's all done by 2030 here, Matt. 2030s, that's when it's supposed to happen. I mean, expectations versus reality. We are covering a lot here, but let's get back to mining and maybe talk a little bit of the status of the junior miners here. Capital, it's hard to find inflows here, but I mentioned silver linings here, Matt, and you kind of continue to see that supply demand thesis within the copper market. There are some. It's exploration season in BC once again. In the northern. So we're going to see a lot of activity. I think one of the things I noticed is, other than the market just being absolutely awful, the work is still positive. There's a lot of people doing good work. Like good companies have found a way to finance to get back on the ground. And I think if there's any sort of shining light, it should be those companies who are able to get to weather this storm, isn't there?
Yeah, I mean, you're seeing some good companies out working. You're also seeing some M&A, like Attack just got bought out. There have been a few of those. I also I'm kind of keeping my eye on a few companies that are going out of business. They're reverting to being shells, and they need to. There are a few out there that shouldn't be capitalized, and so this is one of those times where we should see a contraction in the number of companies out there working, because then we can focus capital on those companies that you're pointing out that are doing good work, that have viable projects, that are run by real good geoscientists, and that can grow wealth. They can take that intellectual concept and make a discovery for all of us. So
if adding shareholder value really comes down to partnering or merging with another group or another company, why aren't people doing it?
Ego? No, I don't know. It's funny you should say that, because I was looking at the copper juniors on the venture that are exploring in BC, right? Because as you said, it's time, right? And there are, 2/3, I bet you, of those copper juniors, and I call them, but basically, you find all the companies that have copper gold projects in BC. 1/3 of them are under 30 million market cap, and of those, probably more than half of them have 150 million shares out on their way to 250 million shares out, right? Yeah. And they're raising money at 7 cents or 11 cents or whatever it is, and it's just it's a grind to just diluting the heck out of the people who helped you start that company and helped you along the way. And that's they need to be merged, right? Or they need to go out of business, and the ground needs to be restaked by somebody else, so that you can put together a team of geoscientists to high grade those projects and figure out what's really worthwhile, right? And why isn't it happening? I do think ego is part of it. I think a lack of capital is part of it. It takes money to stake big large areas of ground, and you still have big chunks of ground in BC that are held in private hands, and that they aren't interested in putting them into public companies, because public companies don't always do what you would do if you were private.
Yeah, absolutely. Let's wrap it up here real quick. I've taken a lot of your time, and listen, I'm hoping for a shorter week, a little vacation, so I'll make this a shorter long form. But I appreciate your time. You still do some writing. Where can people find you?
Yeah, I still write. It's called mangroveinvestor.com. It's mangrove like the tree, MANGROVE investor.com. There's free stuff on the site at called The Grove. There's a lot of free material there, and I also do a little bit of newsletter writing with a product called New Energy, which is about that energy transition we were talking about.
All right, great. And you're on Twitter?
I'm on Twitter. Oh, I think I'm the only Matt Badiali on Twitter, so you can find me.
The only one I know, anyways.
Yeah, Twitter's one of those things where I often comment and then delete it because I think, what would my mom say if I put that on there? But fortunately, mom's not on Twitter.
That's not a bad thing. I think more people could use that practice and exercise. Me included. All right, my friend. Thanks so much for your time. We'll have you on. We'll have you on again here later this summer. Maybe we can talk about some of the news from the exploration season, the things that popped in your attention. Yeah. All right, Matt.
Cool.
And that's a wrap here this week, guys. Short week. I'm off hitting the road. Gonna go see some music. Be safe out there and be well. Thanks.